Welcome to the Deep Dive. Today, we're looking at some pretty striking research on the UK housing market.
Yeah, the mission today is really to unpack this bold prediction that London property is set for a major comeback.
Right, after nearly a decade of underperforming the rest of the UK, it feels like a big call.
It really is
Yeah.
because the context, I mean, look at it. London homes saw only 1.4% growth recently?
Yeah, tiny. While the UK average was closer to 3%, we're talking about a market with average prices over £500,000 just lagging.
Exactly. Thoroughly outperformed for 9 straight years.
But now, Capital Economics, Ashley Webb, as the Economist cited, they're forecasting London prices will surge a massive 6.5% next year.
Which would blow past their own UK forecast of 5%. So yeah,
Yeah.
huge turnaround predicted.
Okay, let's get into what are the main drivers they see behind this potential shift?
Well, the core idea really is leverage. Because London is so expensive, any financial shift gets magnified there.
Okay, so higher prices mean interest rate changes have a much bigger pound and pence impact on affordability.
Precisely. So driver number one is exactly that. Mortgage rate leverage.
Right.
They expect quoted mortgage rates to fall, maybe from around 4.2% recently down to about 3.7% by 2026.
That's a fair drop, 0.5% or so.
It is. And because affordability is, most stretched in London, that 0.5% drop adds potentially tens of thousands to buying power there.
I see. So when rates fall, London bounces back faster because the impact is just bigger.
That's the theory. Highest leverage means fastest rebound.
Okay, makes sense. What's the second driver? Another boost to buying power.
Kind of, yeah. It's about loosening lending criteria.
The loan-to-income rules.
Exactly. Banks are now permitted to issue a slightly higher share of what you might call stretch mortgages.
Right, where the loan is more than 4.5 times the borrower's income.
Yes. They can now issue more than 15% of their new lending above that threshold.
So for you, the listener, this just means banks can lend a bit more relative to salaries. And because London's price-to-earnings ratio is already, 1.5 times the UK average?
This rule change gives the biggest relative boost to London buyers. It helps bridge that affordability gap, at least on paper.
Though you could argue it adds risk down the line.
That's a whole other debate. But for near-term prices, it's supportive. Then driver 3 is supply, or the lack of it.
The supply crunch.
Right.
Always a factor in London.
Especially now, it seems. While housing starts rebounded elsewhere in the UK, in London, they actually fell further, down 68% measured against existing stock by Q1 2025.
Wow, 68%. That's steep.
It is. And things like office conversions, they're just not filling that gap. Very low levels of new builds hitting the market.
Okay, so falling rates, easier lending, and almost no new supply. That's the case for the boom. But this is where it gets interesting, right? Does everyone agree?
Not at all. And this is crucial. Knight Frank, the estate agency, they have a very different view.
What are they forecasting?
They see 4% growth for the UK overall next year, which is, quite close to Capital Economics' 5%.
Okay.
But for Greater London, they're only predicting 3%, and even less, maybe 2.5%, for prime central London.
So still lagging the UK average in their view.
Yes. They expect London to keep lagging until at least 2029. They argue affordability constraints are just too powerful, even with slightly lower rates. A 6.5% jump seems unrealistic to them.
And we also heard from Jeremy Leaf, former RICS chair. He added more nuance, didn't he?
He did. He stressed that London isn't just one single market. You can't paint it all with the same brush.
Right. Depends on the property type, the location.
Exactly. He sees stronger prospects, maybe higher increases in popular suburbs, and particularly for single-family houses, those are still in high demand.
But the flat market is different.
Very different. He described the central London flat market as, quote, plagued by oversupply. That's going to keep a lid on price growth there.
So it's a story of divergence even within London itself.
Definitely. And remember why London underperformed for so long from about 2016 onwards.
Yeah, we had slowing employment growth after Brexit, higher taxes hitting buy-to-let investors.
High mortgage rates more recently, and of course the big one, the shift to remote work.
Which let people move further out, looking for bigger homes, often cheaper ones.
Right. So this bullish 6.5% forecast from Capital Economics, it essentially relies on the reversal of that high rate trend being strong enough.
Strong enough to kind of outweigh those longer-term shifts, like remote work and the sheer cost of London property.
Precisely. It's betting on the mechanics of falling rates and tight supply winning out over everything else, at least for next year.
So what does this all boil down to for you? Well, the core tension here is between these two forecasts. Will mechanical levers, falling rates, looser lending, low supply really be enough to power that dramatic 6.5% London rebound?
Or will the deep-seated issues, persistent affordability problems, the legacy of the pandemic shift, mean London continues to trail the rest of the UK, maybe closer to that more cautious 3% prediction?
The final thought, perhaps, is this. How much does that extreme supply shortage truly count for when the price of entry remains so incredibly high?
That's the million-pound question, isn't it? Or rather, the half-million-pound question, on average. That tension will define London's market next year.